Mike, clearly the net effect on markets, on the S&P 500 at least, whether it's today or this week, has not been negative.
It's mild. For months, my case has been, my belief is that trade as an overall issue wasn't the big make or break swing factor. It's a net negative if it goes wrong. It's an annoyance. It's an extra bit of friction. But as dramatic as all this is that we're watching today, I think you have to step back and say that worst case scenario, maybe NAFTA stays in place and the law of the land for 25 years is the law of the land, and the supply chains remain intact. And the market kind of gets that when it comes to this particular negotiation. So the stakes seem high. It's kind of amped up in terms of the emotion level for what you would versus what you would expect or hope for. But unless we actually see the president imposing tariffs on cars called Chevrolet Equinoxes and Dodge Chargers assembled in Canada that come back to the United States, that I don't know that the market has something to react to so much right now.
Yeah, it is hard always for the market to process any kind of breakdown or rift in diplomatic relations, which may be more serious consequence, I don't know. Or, Mike, is this the Friday before Labor Day, and we're going to come in Tuesday with another giant uncertainty as it relates to trade? Who knows how to extrapolate what this is going to mean for the China negotiations, which the market does care about.
Yes.
With that economy being
that
so large.
Would narrow the focus a little bit, but I could also have spun it the other way and said, well, if we fell out of bed today in the markets, you'd be like, well, it's a Friday before Labor Day, it's an illiquid market, we get air pockets all the time. I just don't think the market knows what it's supposed to be pricing in right here when it comes to this phase of the whole trade.
Treating it like a lot of noise.
I think we have to really reconsider the fact that according to CEOs and portfolio managers, the global trade system was not in need of urgent repair before this president took office. He likes to be aggressive. It's a win-win if he seems like the tough guy and everything more or less stays the same.
Lindsey, in terms of what this all means, I mean, earnings so far clearly not been impacted by trade, and one would expect that can continue for the next quarter.
Oh, absolutely. For the second quarter, 25% earnings growth is what we got. It was better than the 19% expected going into the quarter. We're still looking for 22% growth in 2018. Now that's going to be reduced to 10% in 2019, but the fundamentals are strong. The big story here is that sales have been extremely strong and improving over the last several quarters. 10% sales growth in the second quarter. If we can keep that, the margin concern that everyone has with prices rising, especially in the wake of potential tariffs, we can maintain those margins if sales are able to continue to grow at a double-digit pace.
You've been looking at the estimates and the guidance and putting it all together. Are we going to continue to see double-digit sales growth?
We are for this year. Now, 2019, the numbers still look pretty weak. About 5.5% top line growth is what the consensus estimate is. But I think that can change if the economic fundamentals remain as strong as they are right now.
Jim, let's talk about the dollar, because clearly that has been affected by U.S. trade headlines. Stronger today, but not too strong actually for the week or for the month as a whole. What's your view on the dollar at the moment, and how much it's going to impact the equity markets?
Well, the dollar pulled back a little bit and then bounced right off support, just like they drew it up that way. And if you look at the dollar, it really is driving a lot of investment themes. A strong dollar means more money's come internationally to the U.S. That's a tailwind. I like tailwinds. Also, the strong dollar has pointed the way to small caps and mid caps, which have had a very, very good year and look to continue that way. Look, we have a Federal Reserve Board that's raising rates, and nobody else in the world is. The Bank of Japan isn't. The European Central Bank isn't. The People's Bank of China isn't. So the dollar should continue to be fairly healthy relative to these other currencies. That should mean the themes that have been prevalent in this year's market should continue, and I expect that. And that means maybe more pressure on emerging markets, maybe more pressure on international markets. But for the U.S., it means money flows coming in. For small and mid caps, it means very good things, and they've been acting very well in here.